Realty Income is down 19% over the last year. In fact, in the first month of 2024, it is down 4%. Is this a company that is undervalued and a must buy, or should we be looking elsewhere for our money? In today's episode, we're going to run through lots of different information. We're going to look at their income statement, their top line revenue and bottom line net income to see what we expect from their 2023 results. We're going to have a quick look at the balance sheet. Is this a company that is strong for the next few years? Total cash versus total debt. We'll also see, is this an issue that just Realty Income is facing, or are the other REITs being hammered over the last year and 5 years? We'll also see what the institutions have been doing in the latest quarter. Have they been buying more or selling more shares? As always, we will take a look at their dividend safety, looking at their financial metrics and seeing what we expect for the financial metrics in 2023's annual report. We'll also touch upon some insider selling by the director at the end of December, and we'll touch upon two press releases that Realty Income have come out with just recently. So don't forget, we will also put them through the valuation model, getting to what we believe to be the intrinsic value as well as our acceptable buy price, given that investor margin of safety, and having a quick look at whether or not Wall Street do predict upside for Realty Income after a very poor last 12 months and even start to 2024. So let's start with their historical performance. Now they are down 4.5%. Yes, only 1 month has started of 2024. Over the last 10 years though, we have seen they are down, or in fact you would be up 39%. That doesn't include those dividends reinvested, but they are down from the all-time highs of that pre-COVID 2020 February at $80. Now when we look at the 52-week range, they are towards the mid to lower end of that 52-week period. They do offer a starting yield now of 5.6% and a forward PFFO of 13.36. So let's take a look and see what we're expecting for 2023 for Realty Income's top line. Now remember, what we typically like to see in REITs is 5 to 10% growth year on year. What's positive with Realty Income, their top line from 2018 to 2022 has increased, and on top of that, those consistent increases year on year. Now, we will touch in one of those press releases, but they are expecting their trailing 12 months, so December 2023, to again show an increase to their top line from 3.3 billion to 3.9. So it's nice to see consistent increases year on year, and we will touch upon the AFFO per share as well, which is a better metric when analysing REITs. Now, in terms of their net income, what we can see, again, growth 364 million in 2018, 870 in 2022, and again some increase expected into December 23. But unlike the top line, we do see the bottom line a little bit more inconsistent, increase to 2019 before dropping down to 2021 and then picking back up. So their top line and bottom line, we are expecting an increase in December 2023's annual report. And in actual fact, you can go ahead and look at that first press release, and essentially Realty Income have announced for their fourth quarter and year-end 2023 results that they are expecting to release them after the market close on February 20th, 2024. So don't forget, in fact, to subscribe, hit that bell button, as we will be covering that article, that report when it does come out, to see whether or not it is as strong as we expect. Now, in terms of the health of the company, total balance sheet, or in fact total cash versus total debt, we can see their cash has gone from 10 million in 2018 to 344 million. So that is positive. They are holding on to more cash. They didn't have that much 5 years ago. And when we compare it to the total debt, whilst we do see it increasing from 6.5 billion to 21 billion, it isn't necessarily alarming, just due to the fact that this is very typical with the REITs, especially as they grow. And we do have some nice metrics that we will analyze shortly when analyzing whether or not Realty Income is strong for the future. Now, in terms of how others have performed just this year as well as the last 5 years, we have Simon Property Group, Kimco, Federal Realty Trust, a few of these which we have analysed on the channel before. Now, over the last year, Realty Income is down 15%, and you can argue all REITs have been hammered, but we do have companies like SBG, which is up 20%, and we do have REG, which is essentially flat. So yes, somewhat with interest rate increases that have hurt REITs across the board, we do in actual fact see some REITs still returning positive returns on investment over a year. Now, when we extend that to the last 5 years with Realty Income, we see it as one of the middle performing, up 7.5%. So that is a bit of a worry there. If you're looking at REITs, Realty Income, and we're saying is one of the middle performing, if it's up only 7.5% over a 5-year period, that isn't that great. Remember, this includes those dividends reinvested. However, we have Kimco, which is up 51%, but the majority of these REITs haven't been performing well over the last 5 years. That includes Realty Income, Simon Property Group, and we have FRT down 2%, Triple N only at 1.9%. But remember, what is key, past performance is never an indicator of future performance, but it is one level of analysis we like to look at. Now, institutional ownership, as always, 79%, and we can see here $2 billion worth of sales by the institutions over the last 12 months, with significantly more buying over the same period. Now, the latest quarter, Q4, we actually see more buying from these institutions, 119 million versus 46 million sold, and it is something that is consistent quarter on quarter in 2023. So that is positive, especially if you are a buyer of Realty Income. But as always, you need to do your own investment thesis and not worry about what the institutions do, whether they buy or sell. But it can be interesting to see whether or not they also agree with your investment thesis. Now, one thing that I do want to pull out from this information is the second press release, and that is to confirm that Realty Income did close their merger with Spirit Realty Capital. Now, on other analyses of the Realty Income on the channel, we have done a thorough review of how we expect synergies between the two companies, a lot of overlap in their tenants and their stores. So it does look like it should be a very positive merger for shareholders of Realty Income. And for those that just want to know, essentially, nothing is changing. The common stock of the combined company will still trade under the ticker symbol O. So let's take a look now at insiders trading. Now, typically, what we like to do, look at the last 3 months to see whether there's been any insiders buying or insider selling. What we note here, Larry Chapman, one of the directors at Realty Income, has sold around 3,500 shares at around $57. So we can see since then the share price has come down around $200,000. Now, for those that are new, I would say insider selling isn't really a bearish signal. Insiders sell for a wide range of reasons. As we say on the channel, it can be personal reasons, it can be financial, many others. The one sell or the one signal that we would look for and that we would say to be aware of is insider buying. When you start to see management buy, that is a very strong signal, a very bullish signal, as insiders typically only buy if they believe the share price is going to go up. But as always, it is best to do your own due diligence regardless of whether or not insiders are buying. So let's take a look at the dividend safety. Now, the score is sitting at 80. Their market cap is 39.8 billion. It is a large cap company. And we can see that they did increase the dividend during the last recession. They had above average growth, negative 0.8 versus negative 12 of the S&P. They also outperformed the S&P 500, negative 43% versus the S&P's negative 55%. Now, dividend growth last full year, 4%. So what would I say to that? It's in line with inflation. Remember, the US inflation rate over the last 40 years was 4%. If you are getting less, you are taking a pay cut and losing your purchasing power, whether that's your salary, dividends, or other income-producing assets. So you are basically keeping up in line with inflation year on year with Realty Income, but you are getting a nice yield of 5.6%. Last 5 years, slightly lower. Last 20 years, 5%, so that is positive to note for long-time shareholders. They are also a dividend aristocrat. They have been increasing those dividends year on year for 25 years or more. Now, dividend yield theory, for those that are new, states the company is undervalued when the current yield sits above the 5-year average. 5.6 versus 4.41. So there we go. We can see that undervaluation signal. Another signal here with the forward P to FFO below the 5-year average of 17.9. Bear in mind that we don't look at any of these models in isolation. We will draw conclusions at the end. And we do note the real estate sector P to FFO is slightly higher at 13.9. Now, we do prefer using the free cash flow, but for REITs it is a lot more volatile, so we stick with the adjusted FFO, funds from operation. Below 90% is our preference. What's nice to see is other than 2013 where it hit 90%, it has started to come down consistently year on year. 76% in 22, 76% expected in 2023. Don't forget, we are expecting their results to come out over the next few weeks, so it will be interesting to see that come out. Adjusted funds from operations increases consistently year on year. Very nice to see from any investment, especially in the real estate investment trust industry. $4 expected in 2023. $4.13 in 2024, and what will be interesting in their earnings is when they do discuss that impact they expect Spirit Realty to have, and that will be, in my opinion, a very strong one for shareholders. Sales growth, remember, steady moderate growth, 5 to 10%. We can see pretty much double digits every single year. 2022 at 60%, very good to see. 2023, 24%, again, very positive. And when we take a look at the adjusted funds from operation per share growth, which is a little bit better to look at than sales, we can see it has been pretty strong over the last 10 years. 2022 at 9%, 2023 at 3%. It is positive to note. Now, when we want to look at sales numerically, a lot of people will prefer the numbers than percentages. 780 million to 3.9 billion expected. Shares outstanding, now this is one that I wouldn't say necessarily a red flag indicator, but something to consider. It is typical of REITs for them to dilute your position over time. The reason they do this is because they need to issue equity to fund property acquisitions. Remember, they don't retain a lot of that internally generated cash flow as they pay out a lot in dividends. What I would say is, if you want to get a benchmark, look at the other REITs we do analyze on the channel or when we analyze a group of REITs. And you can see that some dilute your position faster than others. In my opinion, Realty Income is one of those that does dilute your position at a quicker rate than other REITs. It isn't necessarily bad if they are also increasing their funds from operations per share as well. ROIC, remember, what we want to see is 10% or more, but for REITs we look 3 to 5%. These numbers give us faith that management are able to effectively allocate their capital. 2023, 3%. It isn't bad, 2022 as well, but I would like to see the consistency of the 4% we saw for quite some time. Anything lower than that is a bit of a worry that we saw in 2021. Operating margin, nice to see, very strong and high numbers. It did dip in 2022. Positive to note, we're expecting it to go back up slightly in 2023, and let's hope it does continue to go back up to the high 40s, low 50s. Now, this is an important one. This is the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Remember, it shows us the balance sheet strength as well as dividend safety. We want to see below 5.5. These are the number of years it would take the company to pay off all of their debt net of cash on hand. 6.21 in 2022 is a bit too high for my liking. 2023's annual report, we're expecting to see 5.97. Again, a bit too high. The positive to note is 2024, we are expecting this to come down to below 5.5. But right now, whilst I do have some hesitation, I do still believe that dividend does remain to be safe. Something just to keep an eye on moving forwards. So let's jump into the valuation model. If you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And before we get into the numbers, just to let you know, we have released the second weekly newsletter for our Substack. As always, if you want to gain a copy, it's completely free. Click on that pinned comment below. Every week we talk about a different topic. 2 weeks ago, or our first edition, was on the 7 golden dividend metrics to identify undervalued stocks. The one we released just a few days ago was talking about an undervalued company with strong upside. So let's jump into the valuation of Realty Income. Now, for the first model, Graham's valuation, which is part or 1/4 of this valuation model. For REITs, it isn't applicable, so we'll jump straight into the first one that we'll use, the multiples valuation model. We're analyzing companies in a similar sector and size. We have them on the screen. We get their PFA multiple, and we get the average, and we have that of Realty Income. The intrinsic value based on this model comes to $66. Now, as we can see, it is much higher than the market value, so we have that undervaluation signal. Just keep in mind, we don't look at any of these models in isolation, and we draw our conclusions towards the end. We then have the dividend discount model. Now, in the more recent period, we have average growth of around 3.14%. We have gone pretty much in line with that. You could argue it is a little bit more conservative if you are expecting them to bring it up to 4%. Based on this, the intrinsic value comes higher than the market value again, so we have another sign of undervaluation. We then have the DCF model with the free cash flows year on year, average growth rate per analyst estimates, and the discount rate. We get the present value of these future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we have our intrinsic value again. So we have 3 signs of undervaluation. As always, the intrinsic value is just the average of these three models, and don't forget you can get to the intrinsic value and acceptable buy price of companies in your own portfolio or those in your watch list by clicking below, and you can grab a copy of this stock valuation model. So let's jump up with a margin of safety. As always, we use 10% if we believe it meets three criteria: wide moat, strong financial metrics, good forward-looking data. We can see it be a buy up to $59.52. If we use 15%, up to $56, and at 20% around $52.91. So right now we see around 15% margin of safety. Now I'm going to talk a little bit about my strategy here. This is one I do hold. I have been adding for quite some time when it was at its 52-week lows, even at the current price now. So what I am going to do going forwards is I will wait to add this at around a 20% margin of safety at around $52, $53. I do believe even at these current prices, it is undervalued. There is some strong upside. I feel like when those interest rates do start to drop, which we will see, in my opinion, some rate cuts in 2024, that a lot of REITs will start flying. Now, there are many undervalued REITs in my opinion right now. Another one is Mid-America Apartments, as well as, just to name one of a few. So I will be adding this again. It is one I do currently hold, but I will be waiting now for a 20% margin of safety. In terms of Wall Street, well, they have a price target of $63, so they do see upside of 14%. As always, though, do let me know your thoughts in the comments below. Is Realty Income one maybe you've stopped buying? Is it one you're looking to add again? Or are you also waiting for a lower price similar to me? As always, have a great day. If you enjoyed the episode, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. And as always, see you on the next one.